Hello everyone, welcome to my channel. My name is Ozturk. Today I want to talk about what EBITDA means. I'm sure many of you have heard of this terminology a lot, and especially the new entrepreneurs are asked this question. How much EBITDA are you generate? That's mostly the first question that angel investor is asking you. So why is it so popular, and what is it, by the way, and why do we use it so much? A couple of questions that we will be covering today. One of them is what is EBITDA? The second one is why is it so popular? And third one is what is the difference between an EBITDA, net income, and cash flow statements? And if we have those two statements, cash flow and net income, why do we use EBITDA? So let's start with what is EBITDA. In the purest form, it's operational revenues minus your operational expenses. So EBITDA is trying to find out what your operational and financial performance is. So that's the whole basic idea around calculating an EBITDA statement. So what does the name stand for, by the way? It's 6 letters. Earnings before interest, taxation, depreciation, and amortization. So EBITDA stands for the first letters of those 6 words. So it's common, by the way, it's almost global. Everyone uses EBITDA in different languages. So almost none of the countries try to find a new name for it. Everyone uses EBITDA as a common terminology. So why do we use it so much, and why do we need it? So the first answer is everyone is trying to understand cash generation capacity of the businesses. That's the whole idea around trying to find the EBITDA numbers. And because investors are evaluating companies, because entrepreneurs or the business owners are trying to define their cash generation capacities, everyone is seeking an easy way to calculate cash generation capacity, and they found this name for standing called EBITDA. So who uses EBITDA? Who are the parties using EBITDA so much in their daily language? The first one is obviously the investors, corporate investor, private equity investor, or an angel investor. And the second one is, of course, the business owners and the entrepreneurs are using it a lot. And thirdly, the banks are using EBITDA definition a lot. And you may think that, and you may understand that those 3 are the investors to the businesses. Banks are giving loans to the business. Investors are giving capital to the business. And business owners are already giving capital to their businesses, and because they put capital and money into the businesses, they are trying to understand how much cash they will get back from those businesses. That's why EBITDA is so popular. At the end of the day, everyone is seeking a return on their investments, and EBITDA is an indicator for that. So this is the essence of EBITDA calculation. And if you look at net income versus cash flow versus EBITDA, I always have this diagram of triangle for this. You have EBITDA at the top, but you also need net income and you also need cash flow. So you need to triangulate your financial statement analysis to make a right financial statement analysis. You need to look at those 3 all together. One of them or 2 of them is never enough. I'll tell you why we need 3 of them all together in the later stages of the video. So let's start with cash versus EBITDA. So if I'm not a finance person, I would ask myself, so if I have cash flow statement, why do you need EBITDA? I'm already looking at the cash flow statements. Who produced this terminology, or why do we need EBITDA? So 2 reasons for using EBITDA instead of cash flow statements. One of them is terminology, one of them is very technical. And the first one using EBITDA against cash flow is that EBITDA is very easy to calculate. So it took me personally 3 years to really understand and prepare some cash flow statements. It's tricky, and it's like you have direct cash flow, indirect cash flow, etc., etc. Because it's a complicated study, no one would like to spend time on it and try to find some technical calculations. And if you look at EBITDA calculation, it's almost in 2 minutes you can calculate an EBITDA out of net income statement analysis. So easiness and convenience of calculation is the first and foremost reason for using EBITDA against cash flow. And that's why it's so popular. And the second reason is a technical one. So if you look at cash flow statements only while evaluating a company's financial performance, then you would be misunderstanding some of the working capital cycle movements. How? So you may remember from my first video that we had income statements and we had cash flow statements. And the difference is that your working capital cycle. So think of a company operating in retail sector, for example, and that retail company is collecting all the revenues in cash. And if you look at the payment terms, it's making its payments to its distributors, personnel, etc. with some maturity dates. So because of this mismatch of collections versus payments, there is working capital surplus. Let me say it's cash surplus, but it is fully artificial cash. If you just purely look at the cash flow statements of that business, besides having very low EBITDA numbers, that company may be seen to be producing cash at the bottom line. But that cash belongs to the vendors at the end of the day. That's why if you just look at the cash flow statements, you may assume that, oh, this company is doing a great job and I will invest into this company. But if you look at the EBITDA performance, maybe it's break-even. It's the other way around as well. Some companies are misjudged by their cash flow performance. How? Some companies are burning cash during operational cycle, but at the end of the day, they are making profits. So just purely looking at cash flow statements is not gonna be enough. You need to look at EBITDA numbers as well, due to the mismatch of payments and collections in the company's working capital cycle. So that's why think of the triangle. You cannot just look at EBITDA, you just need to figure out what's going on in your cash flow as well. So that's the two things are the differences. Easy way to calculate and the working capital cycle could be misleading are the two reasons that we sometimes prefer EBITDA against cash flow. So that's the first part. If you look at net income, if you're a new entrepreneur, most of you, I'm sure, asking your accountants, can I see my financial results this month? And the accountant brings you what? The net income statement, and along with that usually comes over a tax declaration form. So you're trying to understand your net income statement, and you also would like to see how your competitors are doing. But is there a way to kind of do a apples to apples analysis? So that's the reason that EBITDA is trying to eliminate some of the costs that vary across different companies due to different strategies, and that vary across different companies, and that's why EBITDA eliminates such costs from the net income analysis. So let's remember what they were. So EBITDA eliminates interest costs, depreciation and amortization costs, as well as the taxation costs. Those three cost items that are included into net income statement analysis are taken out from EBITDA. But why? So the reason is that every company has different drivers of those cost bases. So let's start with depreciation and give you some examples to make it easier for you to understand. So depreciation, let's assume a company is operating a big manufacturing facility, and the other company is just a retail company having lots of stores. So the big manufacturing facility has a huge base for investments, right? Because it has the building, factory building, and also big landscape of machineries. So that's why it has a big base for depreciation expenses. On the other hand, if you look at the retail company, it doesn't own any of its stores, and also it doesn't have any machineries, etc. So depreciation in the retail company is very minimal. So if you're trying to compare the net income level of those two companies, then you may be misled, because one of them has a very low net income production capacity and one of them has higher net income capacity due to different levels of depreciation. That's why we take out depreciation in our analysis to make the companies like for like and take out the investment profile of the businesses from our analysis. That's the first one. And if you look at the interest expenses, it's completely a different scenario, because think of a company that was fully funded by the shareholder. I love those companies, by the way. There is no bank loans, everything is funded by the shareholders, and it's a good operating company. And if you look at the second company, the shareholder decided not to put any money into the business. It's a good idea, etc., etc., but the company is fully funded by the bank loans, financial leases, or any other types of third-party investors. So from that angle, the second company has high interest costs and its leverage is high. On the other hand, the first company, if it is also operated in a good manner, it has no interest costs, because it has a different capital structure or capital injection strategy. So if you're trying to compare the net income or bottom line analysis of those two companies, you may again be misled, because one of them has no bank loans, no interest, one of them has high interest. So that's why their net income production capacity could be different. Again, EBITDA eliminates interest costs due to those, depending on different information sets, those different cost bases. And lastly, taxation. I'm sure many of you hate tax analysis and you just don't want to bother with those complicated tax studies. But taxation is really dependent on the country, because different countries have different tax rates. Dependent on the sector, some specific sectors are incentivized by the government, or company based, because some companies may have some specific investment allowances, or they may have accumulated losses from previous years, etc., etc. So due to these different dynamics in the taxation, it's almost impossible to compare companies on an apples to apples basis and see how taxation is working. That's why, again, EBITDA has the global goal of comparing companies across different sectors and across different dynamics. EBITDA eliminates taxation expenses, again, in its analysis. So I told you three things: taxation, interest, and depreciation are eliminated in EBITDA. Again, in net income, you have those types of costs. Again, I'm not saying that you do not need to bother about anything depreciation or taxation expenses. Those are three important cost bases for a company's cash generation capacity as well. A company might be investing too much or over investing into its business, and depreciation expenses might be too high. And if you look at the taxation, maybe tax strategy is not the right strategy currently and needs to be changed. And if you look at the interest expenses, you need to look at the leverage ratio of the company and how the financial management is performed at the company level. So those three cost items are very important as well. But for apples to apples comparison, EBITDA just assumes that they are eliminated. And if you think about the triangle that we just talked through, net income is also an important element in understanding the company's financial performance. So never forget to look at three things all together when you're evaluating a company's financial performance, or when you're evaluating a company as an investor. So three things. One of them is EBITDA, which is for sure very, very important. and the second one is net income capacity, and the third one is cash flow generation capacity of the companies. You need to do an analysis by reviewing all three all together. So I told you together what EBITDA means and what it stands for, as well as how we compare EBITDA versus net income and cash flow statements. I hope you found it very useful, and if you're a first time watcher, please do not forget to subscribe to my channel. Thank you.